Welcome to the Deep Dive. Today we're digging into the latest from Boston Beer Company, ticker SAS and Yum. They just dropped their Q3 2025 results after the bell on October 23rd.
Yeah, and this one was really interesting because the market, well, it reacted pretty strongly, didn't it? Shares jumped the next day.
They did. But the numbers themselves, they kind of told two different stories, right? There was this real tension.
Exactly. You had this positive market reaction, but underneath, the financials were complex.
So that's what we need to unpack for you today. Was that rally built on a real recovery?
Yeah.
Or was it, some amazing financial maneuvering just papering over some deeper volume issues?
It's a classic conflict story playing out in the numbers. Let's start with those headline figures because they really set the stage.
Okay, give us the rundown, the top and bottom lines.
All right. So it was what you'd call a beat and miss. The beat, the good part, was on the bottom line. JAP EPS, earnings per share, landed at $4.25.
And the street was expecting what?
Consensus was around $3.78, so $4.25 is a solid beat, about a 12.4% surprise, which is significant.
Okay, so that explains some of the positive reaction. But you said beat and miss.
Right. The miss came on the top line. Net revenue was $537.5 million. The street wanted something closer to $542 million, maybe a bit more.
So missed by about $4 to $5 million there.
Yeah.
And year over year.
Down 11.2%. That's a pretty hefty decrease year over year.
Okay, wait. So you beat earnings by over 12%, but your sales are down over 11%. How does that even happen?
That's the million-dollar question, isn't it? And the answer really is margin execution and some serious cost control. They managed their costs incredibly well, despite the headwinds on volume.
Let's talk volume then. What did those numbers look like?
It was a bit mixed there, too, actually. Depletions, that's what's actually selling through to consumers. They were down 3% compared to last year. Not great, but maybe not catastrophic.
Okay, down 3%, but revenue was down over 11%.
Exactly, because shipments, what Boston Beer actually set out to their distributors, those fell off a cliff, down 13.7%.
Whoa, 13.7%. So they shipped way less than what consumers were actually buying.
Precisely. And management was pretty clear this was about distributor inventory. They'd apparently shipped ahead of demand in earlier periods, maybe last year too, and now they're correcting that. Pulling back shipments to let distributors work through that excess stock.
Makes sense. So the underlying demand, while soft at negative 3%, wasn't nearly as bad as the shipment number suggests, but still that discipline on shipments must have hurt the top line.
It did. But that discipline, especially on the production side, is what absolutely saved the quarter from a profit perspective.
Okay, let's pivot to that then. The margin story.
Yeah.
Because you said that's where the magic happened?
Absolutely. This is probably the single most important number in the whole release. Gross margin came in at 50.8%.
50.8%? That sounds really high for them, doesn't it?
It is. It's a massive jump, 450 basis points higher than Q3 last year. And management made sure to point out it's the best gross margin they've posted since way back in 2018.
Okay, 450 basis points in this environment. That's not just luck. How did they pull that off? What were the levers?
It was a combination of things, really. They mentioned procurement savings, so getting better deals on their inputs, improved efficiencies in their breweries, price increases definitely helped too, and favorable product mix played a part.
You mentioned brewery efficiencies. Was there anything specific there?
Yeah, the big one was shifting more production in-house. They said 90% of their domestic volume was produced internally in Q3.
90%. Wow. What was it before?
Last year, Q3, it was only 66%. So moving from 66% to 90% internal production, that's a huge operational shift. It means better control, better utilization, and it really helped fight off that volume deleverage effect from lower sales.
So they got much more efficient at making the stuff they did sell.
You got it. And they're doing this from a position of financial strength, which is key.
Right, the balance sheet. How's that looking?
Rock solid. They finished the quarter with $250.5 million in cash. Zero debt. Still buying back stock, too, about $161 million worth year to date.
Okay, zero debt, $250 million in cash. That gives them a lot of flexibility.
It really does. And that financial strength sets up the next really interesting part of the story, the raised guidance and what they plan to do with that improved profitability.
Ah, yes. They took these great margin numbers and boosted the outlook for the full year.
Significantly, the new full-year EPS guidance is now $7.80 to $9.80. That's up quite a bit from the previous range of $6.72 and $9.54.
That's a hefty raise. And margins, too.
Yep, full-year gross margin guidance lifted to 47-48%. And they also narrowed the expected hit from tariffs, now forecasting $9 to $13 million impact, which is maybe less than some people feared.
Okay, so they've found this extra profitability driven by amazing execution. But here's the kicker, right? They aren't just letting that flow to the bottom line.
Exactly. This is where it gets strategically really interesting. They are taking that margin upside, that extra profit, and plowing it right back into the business, specifically into advertising, promotional, and selling expenses, AP&S.
How much are we talking?
They're hiking the full-year AP&S spend guidance to a range of $50 to $60 million. That's a big chunk of change to reinvest.
50 to 60 million extra, or total.
That seems to be the implied increase or total focus for the near-term push. It's a major commitment to boosting brand support.
Okay, so where's that money going? What's the plan?
Two main things they highlighted: increased brand media spending, so more traditional ads, and then this new local market activation program, think grassroots events, more direct support for their wholesalers on the ground.
It feels like a big bet. You've got costs under control, margins are soaring. Why not just bank the profit? Why the sudden urge to spend big on marketing?
Well, you have to think about the leadership context too, right? You've got founder Jim Koch back as CEO. He's always been about the brand, about innovation.
True, the brand evangelist.
Right. And then you've got Phil Hodges stepping in as COO, who seems focused on driving that operational efficiency, the margin side. So maybe this is Koch saying, okay, Phil, you gave me the savings. Now I'm going to use it to try and fix the top line.
A division of labor, maybe. Hodges finds the money, Koch spends it on the brands.
Kind of feels that way, but leads us directly to the risk factor. Can that spending actually work? Because beneath all this great financial execution, the volume trends for the big brands are still pretty worrying.
Yeah, let's get into the brands. Because efficiency is great, but if people aren't buying your main products, that's a problem. What's the backdrop here?
Management painted a tough picture. Ongoing economic pressure, especially on lower to middle income folks. People are moderating their drinking, maybe trading down. And there's new competition popping up, like from hemp-based drinks, apparently. It's hitting the whole beerish category.
And the brand that feels that most is probably Twisted Tea, right? It used to be their star.
Yeah, Twisted Tea is definitely feeling the heat. Even though it's still gaining some distribution points, dollar sales in measured channels were down 5% year to date. It's losing some share.
Why? What's happening there?
It seems like a combination of things. Their core drinker is pretty cost sensitive, so maybe some price increases hurt them there. Plus, retailers are apparently giving more shelf space to competing RTD spirits, which squeezes tea.
So that $50, $60 million reinvestment, is that aimed squarely at Twisted Tea? Trying to fix that.
It seems like a big part of it is they specifically mentioned refining pricing on Twisted Tea, like introducing a new 4-pack of 16-ounce cans priced under $10.
Ah, hitting that lower price point.
Exactly. And also tweaking 12-pack prices in certain markets to make sure it's positioned clearly below imports and craft beers where maybe the price had crept up too much. They're fighting back on price, basically.
Okay, what about Truly, the hard seltzer giant? That whole category's been struggling.
It continues to struggle. The overall hard seltzer category was down about 4% in Q3. Truly is still a top brand, number 2, I think, but the growth isn't there anymore for the base product.
So what's the plan for Truly? Just manage the decline?
Not quite. They're focusing efforts on innovation, particularly higher ABV stuff like Truly Unruly. Apparently that extension is doing really well, gaining share.
Higher alcohol, more flavor. That seems to be a trend.
It does. And the other big lever for Truly is sponsorship. They have that big U.S. soccer deal leading up to the World Cup in 2026.
All right, the World Cup catalyst. Lots of visibility there.
For sure. Expect special packaging, local events in host cities. They're clearly hoping that boosts the brand significantly over the next year or so.
Okay, so Twisted Tea is under pressure. Truly is trying to innovate and leverage sponsorships. What is growing? Where's the bright spot that gives them confidence to raise guidance?
One word: Sun Cruiser. That's their RTD spirits brand. Ready-to-drink cocktails.
Ah, the spirit side. How's that doing?
It's doing very well, apparently. They said it's already the 4th largest brand in that RTD spirit space. It's testing well, getting good traction, especially in bars and restaurants, the on-premise channel.
And that's important for trial, right?
Yeah.
People try it out, then maybe buy it at the store.
Exactly. And it's apparently very good for margins, too. Management sounds incredibly bullish on Sun Cruiser.
How bullish? What are they expecting?
The CEO literally talked about targeting strong double-digit, maybe even triple-digit growth for Sun Cruiser in 2026.
Triple-digit growth.
Yeah.
Wow. Okay, that could definitely move the needle if it pans out.
It really could. If Sun Cruiser takes off like that, it starts to make up for the softness in tea and seltzer pretty quickly.
Any other brands worth mentioning? Angry Orchard?
Yeah, quickly on Angry Orchard, it actually had a second straight quarter of growth. Seems like consumers are maybe shifting back towards more flavor, and they've put some focus back on it too, like the WWE partnership. So a bit of quiet stability there.
Okay, so let's try and synthesize all this for someone looking at Zambia. What's the big strategic story here?
I think the story is clearly mix and margin over volume, at least for now. They are executing brilliantly on costs, on efficiency, getting those margins way up to protect the profit and loss statement.
Well, the core volume is still weak.
Well, the core volume is weak, exactly. They're using that operational strength to buy time and invest in shifting the portfolio. Management talked about the fourth category, basically anything beyond beer. They see that as the structural growth area.
So lean into efficiencies, generate cash, and use that cash to build up Sun Cruiser and whatever comes next in that fourth category.
That seems to be the playbook. The market loved the margin execution and the raised guidance this quarter, but looking ahead.
It all comes down to whether that $50–60 million marketing spend can actually stabilize Twisted Tea and truly, right, stop the bleeding.
That and whether Sun Cruiser can really deliver that explosive growth they're forecasting for 2026. Those are the two big ifs.
Because the risk is that the volume declines in the core brands continue or even accelerate, and Sun Cruiser just can't grow fast enough to offset it.
That's the tension. Fantastic operational control versus persistent consumer headwinds. That's the tightrope they're walking.
All right, perfect setup for our This Is Not Financial Advice segment. Time to pitch an outrageous but maybe plausible trade idea based on everything we just heard.
Okay, so the stock jumped hard on the earnings report, right? But that jump was almost entirely because of the margin beat and the raised guide, which itself was driven by margins.
Not by improving volume trends.
Not at all. In fact, the volume trends, especially for Twisted Tea, are still pretty concerning, and Q4 is usually their seasonally weakest quarter anyway. So the market might be a bit too focused on the margin story and ignoring the lingering volume risk.
So the trade idea leverages that potential mispricing.
Yeah. Here's the pitch. Consider a short position in SAM. Put a clear stop loss just above that recent post-earnings high to manage risk.
Betting that the volume weakness comes back into focus and weighs on the stock.
Exactly. Betting that the narrative shifts from margin miracle back to top-line trouble. But here's the slightly more complex part to hedge it.
Okay.
To potentially fund that short position, you could simultaneously sell some out-of-the-money put options, say, strike price down at $180 or something like that.
Selling puts. Why?
Well, after a big move like the one Sam just had, implied volatility in the options is often elevated. Selling puts lets you collect that premium. And, perhaps more importantly, the company's super strong balance sheet, that $250 million cash, zero debt, probably puts a pretty firm floor under the stock. It's unlikely to completely collapse.
So you're selling insurance against a catastrophic fall, using the premium to help fund your bet that the stock drifts lower on volume concerns.
You got it. Selling downside protection because the balance sheet provides some fundamental support, while betting that the near-term volume reality disappoints the market bulls. Again, purely hypothetical, not financial advice.
Definitely not advice. Okay, so wrapping up, we've seen incredible operational work on margins, a bold reinvestment plan fueled by Jim Koch's return, and huge hopes pinned on Sun Cruiser.
But that core tension remains. Amazing discipline on costs versus some really tough trends for their biggest legacy brands.
Which leaves us with that final provocative thought for you to chew on. Can throwing $50 or $60 million at marketing and clever pricing truly revive a brand like Twisted Tea when its core consumers are squeezed and the category is slowing? Or is that money just funding a managed decline, basically smoothing the transition while everyone waits, fingers crossed, for Sun Cruiser to become the next big thing?
A lot riding on that question. Thanks for joining us for this deep dive into the SAM earnings call. As always, keep doing your own research.